there'll be hiccups along the way with the investments, but as long as overall we're up, then that's the main thing. I was just telling someone in the Substack community chat, Stanley Druckenmiller, who's one of the best fund managers on the planet, says, you know, he's right about 60% of the time, and he's been able to amass billions. So go figure. All right. So thank you for coming. This is the first quarterly investor update that I'm holding. I thought it's probably about time. If you have any questions, feel free to leave them in the chat. I'll be checking that. I don't have to I don't have to admit anyone, which is good. And then like after every sort of section, I'll stop and just double check, see if anyone has any questions, and we'll go from there. So let's get straight into it. Okay. So what's on the agenda today? Today, I'm not going to be talking about what coins should we buy, what coins, when should we sell our coins, is XRP going to the moon? If there's any XRP holders here, you probably know it's already at the moon. What details do you see from copiers? Yep, I'll cover that in a bit, no worries. All right, so today I'll be going through 6 key things: background, investment philosophy, strategy, portfolio, outlook, and then we'll cover any questions that people have at the end. Should go for about an hour. My apologies if it goes a little bit longer, but we'll go straight into it. So starting with background, I'll just get through this stuff as well. It's just, I mean, everyone covers that, but yeah, I've got some degrees: Bachelor of Business, Bachelor of Engineering. I've got a CC level 4. To be honest, and I'll get into that in a little while, I don't pay much attention to what degrees people have and what qualifications, and I'll go through that. Go through why in a bit, but I've developed bull and bear market strategies through crypto strategy sessions for hundreds of folks. Some of those folks I can see are on the call today. I've upskilled investment committees and honed their strategies for some of the world's most prominent crypto funds. Currently, I'm on retainer for 2 crypto funds, one Australian fund, one international fund. I've delivered crypto workshops across 3 continents, so Australia, Europe, and Asia. I've shared the Selling the Top strategy publicly. That's been turned into a Substack newsletter. There's a bunch of folks on here that are from Substack as well, so welcome to you all. And I currently manage a public portfolio on eToro for 1,300 folks, many of which are here as well, with a combined 7.5 mil assets under copy. But that said, none of this actually matters. These are just those things that people like to talk about, their accolades and stuff. I think this is irrelevant. For the most part, these things are irrelevant. What does it show? It shows that, yes, I've been able to do some work over the period of 5 years and get 2 certificates, but that doesn't actually mean that I'm a good investor or a good portfolio manager. The only thing that matters is consistent results, and I'll show you exactly why. So I've spoken about this in the Substack newsletter. This is Joe McCann. He's, had 25 years of experience across Wall Street and Silicon Valley. He's all over the podcasts on YouTube, that sort of thing. This is his portfolio performance. I'm not sure if you can see that, but that's the first 2 orange ones are his portfolio performance, and he's a professional portfolio manager. And right under that is the performance of Bitcoin. So just because you've got the certificates, just because you've completed some degrees or got a CC level 4 from the Chartered Institute, it doesn't mean that you're actually going to outperform BTC or you're a good PM. Recently, Joe McCann actually closed his liquid trading fund after news broke in July that his fund was down minus 78% in 1 year, and this ultimately comes down to risk management. There's a tweet from Sol Big Brain, who's a big time Solana bull, talking about how he invested 10 million and he's down 10 million through the first half of the year, down 78%. So just because you can talk the talk doesn't mean that you can walk the walk long term. I mean, even even short to medium term, he was underperforming and charging exorbitant fees. Another example, this guy, Adrian, he'll be glad if he can get back 70% of his principal from the 6 or 7 crypto VCs that I've invested for years. And I talk a lot about this a lot in the Substack community. Just because they're talking heads and they have a voice on X and they have a voice on YouTube doesn't mean they're actually making money. Just because someone posts a screenshot that says like 200% return, yeah, I could do a 200% return on a $10 portfolio position, doesn't mean anything. This guy, he's been invested through the whole bull run and he's returned 0.7x. So that's another great example. This guy invested in 5 crypto venture funds. All 5 are under 1.5 multiple on invested capital. 2 or 3 of them will basically return him nothing. Overall, he's break even in a bull market where BTC has more than 5x. I've done strategy sessions with folks from that have invested, VC invested, become LPs in various crypto funds, and some of them are probably on this call as well. And they've said as well, like they're waiting for that bull market because they just haven't made those returns. There's actually 2 important lessons here. One of those lessons is just because you've got a degree or you've got some fancy title doesn't mean you're an expert. We saw that with Joe McCann. We've seen that a million times over. At the end of the day, a degree is just a piece of paper, and anyone that's completed one knows that, stuff that I learned, 10 years ago in my 3rd year of engineering, I don't remember it. I need to go back and review it to actually comprehend it. What degrees taught me, my engineering degree taught me was data analysis, mathematics, that I can vouch for that. The second lesson that this teaches us is it's difficult to outperform BTC. And this is why I say for 95% of folks, they should just be allocated to BTC. And that's saying that as a popular investor on eToro. Because I'm just being real. 95% of folks should be invested to BTC. Why? Because it's difficult to outperform BTC or an asset that's growing at 30, 40, 50% per annum. That said, long term, I'm outperforming, and this is historical results as well. Long term, I'm outperforming BTC on the public eToro portfolio. Short term, I'm outperforming BTC, and BTC is my benchmark. If I'm not outperforming BTC, then from a financial perspective, it doesn't make sense for me to be trading, spending all this time, looking at charts, looking at macro data, building out risk management tools, that sort of thing. It makes no difference if I can simply allocate to BTC. So with folks, what I like to kind of say is don't copy or join the Substack community just because of some fancy titles or I can put some lines on a chart. Invest because of consistent results year on year on year on year. And if invest because I'm doing what I said I was going to do. And to understand what I said I was going to do, you can go check my bio out on eToro and the pinned posts on eToro. I said 3 things. One of them is I'm going to make my long-term copiers wealthy. This is not financial advice. I'm going to annualize the portfolio at 30%, and I'm going to outperform BTC. They're my 3 goals. Nothing else matters in terms of portfolio management for me. Those are the 3 things that I want to accomplish, and that's what I'm trying to do, and that's how the portfolio is structured. That's how every trade is made. So yeah, because at the end of the day, I'm just a guy clicking buttons on a screen, on a keyboard, and basically on a screen for you all. I bought the top in 2017, watched my 5-10K allocation dwindle down to $0, maybe $50. And my only edge through being in the space for that long is that I'm analytical. I've got an engineering background. I'm obsessive. I'm obsessive about markets. And the fact that I fell in love with things like personal finance, markets, wealth building, and that's all I can think about. That's the things that I want to talk about. Anyone that's met me in person, they're the things I want to have a discussion with about. In fact, when I first got orange pilled into crypto, and some people will know this already. I remember watching a podcast with the missus, and she was, and I was like, look, you have to come, look. And then we were going through it, and my eyes, I was just wide-eyed. We went to bed that night, and she's woken up at like 2 o'clock in the morning, and I'm sitting on the edge of the bed looking up at the moon. It was a full moon that night. And she's like, babe, what are you doing? And I'm like, I think I just discovered a money tree. And it took 7 years for me to understand and comprehend what's going on in the space, in the crypto space, and build up on my knowledge over time. But that knowledge that I have built up, now I'm trying to share on Substack and eToro, the knowledge that I've built up through 11 years of investing in markets in general and 7 years in crypto. That's what I'm trying to share and get across. I won't get everything right, but at the end of the day, we're all learning here. So I don't pretend to know everything. I'm just trying to do the best that I can. Okay, so moving straight into my why. The obvious one is family. I do it for the people that I love, for my little girl Maya, and for my wife Alina, for my brother, sister, mum, dad, cousins, family, friends, colleagues, that sort of thing. But also I do it because of these 10 reasons. Why do I allocate the way that I allocate? And it's because I don't want to work until 67 years old. I'm not going to do what is expected of us. I want to give my daughter financial freedom to chase her dreams. I want to create generational wealth. I want to live in effortless luxury. I want to be able to wake up when I'm 80 years old and not have to worry about how I'm going to wipe my butt, or 90 years old and worry about how I'm going to wipe my butt. Because at the end of the day, I want to have the ability for all the health and all the best, healthcare afforded to me. But in order to do these things that you see here, and by the way, some people will look at this and go, hell no, no way, I don't want any of this. And that's fine. You have your own why. I expect most of you to look at this and go, nah, I'm not interested. I don't want to live in a high-rise apartment. I want to live in, insert it here. But these are the things that I want, and this is how I structured the portfolio in a way to give me these things. It's also the reason why I go out on the risk curve. Instead of, sitting comfy in the S&P 500 and just annualizing at 8 to 12% per year. So these are the things that I want, and I'll show you why I go outside on the risk curve. So typically, So typically, this is the returns of an Australian super or retirement fund. It's the biggest retirement fund in Australia. So typical returns are about 8.07% per year. We can compound that away. So you might be thinking to yourself, why do they only annualize at 8% per year when we can get so much more? And the reason is, and by the way, I might just add as well, traditional methods don't give me this. They're not going to give me that. Traditional methods, and I'll show you that in a second, are going to give you a traditional way of living. And as you can see, I don't want to live traditionally. So they compound at 8.07%. Call it 8% and just keep that number in mind. Why don't they compound any higher? Because the goal of these retirement accounts or ETFs or diversification and all of that is not to make us really wealthy. It's there to provide us retirement income or capital in the last 20 years of our life. We work till 67, we retire, we live, if we've been good and saved and invested our entire life, we can live comfy on our own money for the last 20 years of our life, so the government doesn't have to pay out pension benefits, and so that we're not a burden on the system. But if you look into their terms and conditions for any super fund or any retirement account, you'll see that they have a dual objective to beat CPI plus a margin and to outperform the median peer funds. So if they're all, if all their objectives are to beat CPI plus a margin and outperform the funds, then they're all going to be about the same. So then I start looking at this and going, okay, well, how much is CPI then? CPI plus a margin. Let's have a look at CPI so I can understand what sort of returns I can expect. And I'm an Australian, so I'll look at Australian CPI. They're fairly similar in developed economies. So if I look at Australian CPI since 2014 to 2025, it's been hovering about 2%. Post-COVID, it's ramped up to 8%, CPI being consumer price inflation. But it ramped up to 8%, and now it's coming back down. So the numbers that we're looking at are, or consumer price index, the numbers that we're looking at are these numbers here. So it's about 2% plus a margin. So what's that margin? 3, 4. So you're looking at 2 plus 4, that's 6%. What did we have here? We had 8%. So there's your returns, CPI plus a margin. If we look at, if you think Australian super, the one that I just showed you, is a big outlier, well, here's an aggregation of all the super funds. So if we take a balanced portfolio approach, we're looking at over the 3 to 15 years, we're looking at between 4.2 and 6.4%, right in line with CPI plus a margin. They're doing their job. They're not doing the job that I want them to do. They're doing their job that they've been tasked to do. So now, sorry, where was I? Yeah, exactly. So that's right in line with Australian super. So now I can look at this and plug this into a compound interest calculator and go, okay, I've got a $50,000 initial investment, compounding at 8% per year over 30 years, depositing $1,000 a month. And because I work a salary job, my pay increases in line with inflation. So it increases 3%, which means over the course of 30 years, I would have 2.5 million. That's what it's going to give me. So 30-year-old at 60 years old, you might have 2.5 million if the expected rate of return is about 8% per annum. Well, then I go back to my list and I go, okay, 2.5 million. Is that going to give me a stunning high-rise apartment, financial freedom for my daughter, creating generational wealth, living in effortless luxury, all of that? For some people, it might be because your why is different. But for me, I see that and I go, no, it's not. Let's go with those numbers for a second. Can you share this calculator? Absolutely, I'll share it at the end of this. Let's go with that number for a second and plug those into a retirement withdrawal calculator. I'm just assuming, by the way, these numbers are like your total investments. You might have investments in retirement accounts. You might have investments in personal accounts, in business accounts, in trust accounts. It doesn't matter. I'm just assuming total is 2.5 mil. Well, then the question is like, okay, how much are you going to spend in retirement? So, for something like this, wanting this, you might at a minimum be spending 150,000 Australian dollars per year. So if I plug in, I retire at 60, I want to live, I don't know if I'm going to live to 100, probably not. But if I'm going to, what I don't want to do is be in a position where I say, I'm going to live to like 80 years old. I plug the numbers and say, yep, all good. 80 years old comes and I'm left with no money at a point where I'm like the weakest and have the least amount of energy. So let's assume that I'm going to live to 100. The savings at retirement are 2.5 million. I'm withdrawing 150 grand a year because I want to live that life. If I run the simulations ending above the initial is 48%. So 48% of the time, I can expect to at least maintain the initial value because remember, I want to pass on generational wealth. Well, that number isn't good enough for me. 48% of the time, I'm not willing to take that risk. So then what do I have to do? I have to have more money or I have to spend less. So if I'm going to spend less, so if I plug in $90,000 a year here and maintain the initial value, yep, sure. 100% of the time, we're going to, end up with at least 2.5 million at the end of that simulation run, or at the end of my lifetime, which I can pass on to my kids. You might say $2.5 million isn't enough, and this is why it's important to understand your own numbers as well. This one too, please. Yeah, Smizen, I'll do that as well. Yeah, no worries. So you start to see the sort of a picture here. that an 8% portfolio return isn't going to get me personally to where I want to be. So then you start looking at asset classes and go, okay, which asset classes will get me there? Cash or fixed interest. This is the Australian government bond ETF, 2% over the last 10 years, 2 to 3% over the last 10 years. Not going to get me there. Bond markets over the last 10 years, 1.65%. Not going to get me there. Aussie property markets, Aussies love property. 4 to 7% over the last 10 years. Is it going to get me there? No, it's not. Let's call it 10% over the last, let's call it 10% in perpetuity for the rest of my life. Is it going to get me where I need to be? No, it's not going to get me there. Gold, it started performing really well recently, but again, 11% over the last 10 years. This is annualized returns. It's not total returns. So 11% per year for the last 10 years. So no, that's not going to get me there. Perhaps in a fiscally dominant regime like we're in now, it's going to perform better, and it might go from 11 to 14% per year. I don't know. The Aussie stock market, the ASX 200, 9% over the last 10 years. No. UK stock market, 7% over the last 10 years. By the way, this is historical data. Many people will say, and it's true, historical data doesn't mean future data. But if we've only got historical data to rely on, we can only base our decisions based on that historical data and our forward-looking aspect of what we expect the future to look like. UK stock market, 7% over the last 10 years. No. US stock market, okay, now we're starting to get somewhere. 14% over the last 10 years. So the S&P 500 doing pretty well. So that's a possibility. 14%. You need to plug those numbers into a compound interest calculator and say, after X amount of years, I don't want to work till 60. You might say I'm 30 years old and I want to work till 45. Well, plug those numbers into a calculator. Is that enough to live off? 14% over the last 10 years. Are you noticing a trend? The trend is most asset classes won't give me the retirement returns or the returns that I need to live the life that I want to live, despite what they teach me in books, in classes, that TradFi tells you, that your favorite investment and financial advisor will tell you. It's just not going to give me the life that I want. So what's the solution? Now I'll get into the investment philosophy, but I'll have a quick look at the questions. What details do you see from copiers? I can see who copied. If their portfolio is open, I can see who copied and their returns, because I can go in their portfolio, percentage returns. I can also see who's left as well, who's copied and who's left. Cool. So we'll go straight into investment philosophy if there's nothing else. So from an investment perspective, there's 3 levers that we can pull. Extend our time horizon, increase the amount we invest, and aim for higher returns. Many people would have seen my posts on eToro saying, like, you just adopt like be allocating every single month, a DCA strategy, or when there's a significant drawdown, invest. Why? Because that's one of the levers that we can pull to increase our wealth, increase the amount we invest, have a long-term time horizon. And the other one is aim for higher returns. So for me, extending our time horizon is a non-negotiable. No, I don't want to extend my time horizon. I'm not working till 60 years old. I'm sorry. Have someone else do that. So then the option is increase the amount we invest. I do that as well. I invest the same amount every single month. Or at least put it aside for investing every single month, and then I allocate when it's the right time to do so. And then the other one is aim for higher returns. So that highlight there is my job. So if my job as an eToro PI is to aim for higher returns to accelerate people's wealth building, that's what I'm trying to do. How do I do it? I do it by maximizing returns while managing risk. So then the question is, well, how do you maximize returns? And the way that I do it is allocating to the right industries at the right time. I assess the macro environment and invest in these industries at the right time. So you've seen me allocate to things like Iron, which is an AI data center proxy. You see me allocate to Tesla, AI/robotics/cars, proxy, Solana, crypto proxy, coin, digital wallet proxy, all on this here. So I allocate to crypto and tech as the fastest horses in the race. Of course, I can't just allocate and just be like, cool, my job is done, because these are 70-vol assets and they're going to have horrific drawdowns. So what I need is strategy, but we'll get to that in a bit. So I just also like you to ask yourself and have a think about this while we're going through this. Moving forward, will the future be more digital or less digital than it is today? That's the question that we need to ask ourselves. For me, if the answer is less digital, then I can't be allocating to tech, because we saw what happened during the dot-com bubble. I'm already 46 and I started now. So how do I maximize return? I do need to retire someday. What is the scenario here? Well, the question is, when do you want to retire, Laura? So if it's 46 and I want to retire by 60, well, you've got 14 years. That's plenty. That's plenty of time. If the goal is 46 and retire by 50, then your option is invest more, maximize returns, and go out on the risk curve. I'm 34 years old. Mizim? 52 here, just go as hard as you can. There you go, Jonathan Payne, nice one. Okay, so the reason why I invest in tech and crypto, because if we look at it from I always say 30,000 foot view, zoom out, zoom out, zoom out, zoom out, zoom out, zoom out, zoom out. Why do I say zoom out? This is what happened since the dot-com bubble. You bought at the top of the dot-com bubble, or near the top of the dot-com bubble. We had a horrific dump, and this is 2025. So we've got NASDAQ up at the top. This is a chart of NASDAQ, Russell 2000, the S&P, the ASX, and emerging markets. So you've got NASDAQ outperforming everything else on a long-term time horizon. What about if we were numpties and we decided to allocate the day before the GFC? Well, here's our horrific drawdown following the GFC. And here's the NASDAQ, again, outperforming the S&P, Russell, ASX, emerging markets. What about the European debt crisis, Philip? Well, here's the European debt crisis. It was flat through the year, down a little. And then NASDAQ, again, outperforming 2012 to today. Hence the adopted long-term time horizon. COVID crisis. Let's say you invested all your money the day before the COVID crisis dumped all markets. So 2020, again, NASDAQ out on top. So it goes back to the question, are we going to be more or less digital in the future? If the answer is more digital, then I want to be allocated to tech. And that's exactly the reason why I allocate to crypto and tech. Next is, strategy. So before that, goal is to retire before Dockers win a premiership. Oh man, you're probably never going to retire, to be honest, Elza. sorry, Simon. Fair to say we're all on this call to not retire at 65, 100%. Yeah, I'm glad it's consensus. 48 here. Yeah, exactly. So we, Gen X, agree here. We want to retire around 65, but it's also about life quality. What do you mean? What do you mean about the life quality, Laura? You want to retire with money so that you can live out a fulfilling life from 65, say, to 85 years old? Is that what you're saying? So if you're 34, when will you retire, leave eToro, and what will you do with your portfolio when you close it all down? Yeah, that's a really good question. When I talk about retirement, I'm talking about, for example, retiring my wife. I actually love doing this. If you haven't already noticed by the amount that I post, I'm on the community chat. I love nothing more than doing this. So some people like to watch Netflix. I can't sit through a full movie. I just want to be at my screen, looking at charts, looking at macro data, strategizing, refining my investment framework, that sort of thing. So for me, retirement is like taking my foot off the pedal a little. Perhaps I reduce the amount of time I spend online. But for me, I don't see myself leaving eToro. The reason being, I have all my friends, all my family, former colleagues, that sort of thing on there. So, and I'm wealth building for them as well. So it's in my best interest to grow everyone's wealth around me. What will you do with your portfolio? Yeah, I couldn't see myself doing anything else. We're going to be 200% more tech than now. Do you own Bitcoins? I did up until a few days ago when I cut it. So a few weeks ago, I cut my BTC, 50% of my BTC stack at 118.3. And then the other day, I had a circuit breaker trigger for BTC at 111. And I cut the other 50% of my position. So I hold no Bitcoin, neither does the eToro public portfolio. Life quality question. Yeah, Max, if you can drop it in there, that'll be amazing. Thank you. And would you advise buying them? Would I advise buying Bitcoin? Yeah. So, like I said at the beginning, I think a HODL BTC strategy is fantastic for 95% of folks. For the folks that want to outperform a HODL BTC strategy, that's who I'm targeting. So that's who I'm targeting on eToro. That's who I'm targeting on Substack, and that's my strategy. But for the most part, there's not many fund managers on the planet, and I've shown you Galaxy Digital's Vision Track, tracking the hedge funds, the international crypto funds. Most of them, if not all of them, are underperforming a HODL BTC strategy. So yeah, I think out of all of them, I would advise only buying BTC, if anything, on a long-term time horizon. And the reason I say that is when I first started in the crypto space, I like talking about finance and wealth building and that sort of thing. When I was going to these events, I'd be talking to folks and I'd start talking about finance and wealth building, and maybe one or two people would say like, yeah, I put all my savings in Bitcoin. That's how I save. That's how I invest. Over time, as the years went on and I started going to more of these events and asking more people, I noticed that the number of people that I was talking to that were saving, not through a regular savings account, but through hodling Bitcoin, was increasing from 2 people to 4 people to 8 people to 12 people to, I go to a conference. The last one I went to was a conference in Turkey, and everyone that I spoke to that was their store of value. That was their savings account. Almost everyone that I spoke to, that was there. So what does that tell me? BTC is where it's at today because people believe it's a store of value. People take it as almost, I don't want to say it, but it's almost like a religion. And if you have an inelastic supply asset like BTC, where supply is constrained and demand increases, then you know what happens to price long term. It goes up. So when people say $1 million per BTC, I see that. Over what time frame, I have no idea. But I do see that because it's an inelastic supply asset. And as more people come online and start saving and investing and saving using BTC as their store of value / HODL strategy, I see that number continue to climb. So that's the only one that I would say. All right, let's go on to strategy, and then I'll move on to I'll get to the other questions. Cool. So strategy. So as I said, two key goals that I have. Of course, make my long-term copiers wealthy, but the 2 key core goals is to annualize greater than 30% and outperform BTC. And the reason I want to outperform BTC is because I'm allocated to BTC. I've already said if I'm not outperforming it, then what's the point of doing anything? Why not just spend time with my wife and daughter and friends and family and just hodl BTC? And the other one is to annualize at greater than 30%. But why 30%? Well, if you plug those same numbers into a compound interest calculator, $50,000 initial investment, 30% interest, 30 years, $1,000 deposited every month with an annual deposit increase of 3%, you end up with $680 million. I know the numbers sound crazy, but when you see this, you realize that 30% is plenty. So I'm not telling you, hey guys, look, I'm going to give you guys $680 million. That's absolutely not what I'm saying. I'm saying my target is 680 million. Why? Because remember I said the three levers that we can pull. It means that you might not ever get to 680, but it means that we can retire sooner. So you might get to 3 million in 10 years, I don't know, and then say, okay, cool, that's enough for me. So we can retire sooner and we can do all the things that we want to do. You might get to 10 million and go, cool, I'm set. I can now adopt a strategy where I can just pull from that, pull a portion from that for the rest of my life, call it 5%, or sorry, call it 3% of 10 million. That's 300 grand a year. That's plenty for me to live off for the rest of my life. But this is the reason why it's 30%, because I do not need to take any additional risk other than 30%, because I can see over time, and this is why I always say, if you're a copier, be invested for a minimum of 4 years to let my business cycle strategy play out, but also because you need time for it to compound returns. If you have a look at year 1 to year 17, the numbers are like a couple million, but from year 17 to year 30 it goes from a couple million to 680 million. So hence the time required. Okay, so how am I going to do that? How am I going to compound at greater than 30% and outperform BTC? So I have 4 key things. I have an investment framework. I have a risk on, risk off tool that I share with the Substack community called the RORO tool. And I have my selling the top indicators. And of course, I take into account TA, technical analysis. So if I go straight into my investment framework, these are the 9 core principles that I invest by, and many of these will look familiar. Maybe you haven't seen me talk about them, but you would have seen me executing on them. So number 1, allocate the most when it feels the absolute worst. In April 2025, we reallocated the profits from the TP, from the take profit that we did in December 2024 and Jan 2025. We sat on our hands. For the most part, we sat on our hands and allocated the majority of the cash when it felt the absolute worst. That wasn't because I just had this idea. It was because I was implementing my investment framework. Number 2, take money off the table when the market is euphoric. Solana in January of 2025, Trump launches a token on Solana. I took a combined 60% off the table between December and January. So that's taking money off the table when the market is euphoric, because what I could see in the charts was all the liquidity was being sucked out of the crypto space and heading straight into Solana, and Solana pumped to 285 or whatever it was. So we took some profits at 280 and 253 in December. Number four, put all your eggs in one basket and then watch that basket very carefully. You've seen I have a very concentrated portfolio, and if eToro guidelines would allow, it would be even more concentrated. But this is directly from Stan Druckenmiller's book, Put All Your Eggs in One Basket and Watch It Very Carefully, because I do this all day, every day. I understand that there's no way, when I look at a PI, a popular investor that has 50 assets in their portfolio, or when I do a strategy session with a client and I look at their portfolio and they've got 50 altcoins in there, I know for a fact that they can't pay attention to 50 assets, because I can't pay attention and I do this 24/7. Hence, I hold up to 10 assets and preferably even less than that. 6 is the sweet spot for me. Have a clear thesis, entry and exit for every trade. Every trade that I take, I write a thesis on it with entries, exits. My Substack community will know that, will know the depth of the theses. My take profit that I just executed on Solana was written in May and posted on Substack. I wrote the numbers in May. It reached my numbers. I took profit. Attend the party early and leave early. And that's exactly what I've done now. So I've taken the majority of the positions off the table. So Solana, 100% off the table. Tesla, 100% off the table at $423. Coinbase, 100% off the table at $308. That's because they reached my TPs. When I was setting those take profit targets, I was thinking to myself, what is the future going to look like 3, 6, 9 months from now, assuming the RORO tool, the risk on, risk off tool, is bullish, and where is it going to find resistance? So that's exactly what I was looking for. The target's reached, which means my TP levels were set appropriately. And then finally, regularly reassess the narrative for your holdings. So the Substack community will know as well how many SOL theses I've written over the years, because it was my largest holding. I'd write one every 3-4 months. If I noticed that the narrative or conditions or something changed, or I wanted to update my take profit targets for whatever reason, then I'd redo my theses. And one of the things that I also tell folks as well when we do strategy sessions is write a thesis. Put a 2-page thesis together for why you want to invest in that thing. Hell, make it 5 pages, because the moment that you have to actually put pen to paper, you'll quickly realize that, this isn't a trade that I want to take. Or, wow, this is definitely a trade I want to take. I want to allocate more. So that's my investment framework. Some folks will look at this and go, attend the party and early and leave early. Some folks might say like, oh yeah, but what if you miss the upside? And to you, I say, like, to me, it's not upside. The upside was investing in Tesla at, Coinbase, for example, at $34, which we did on the eToro portfolio, or $40 or whatever it was. And that was the upside. Now at Coinbase at $300, can it go to 400? Sure. That's a 30% return. So I'm missing out on a 30% return after doing a, whatever it was, 9x on coin. So I just don't look at it from that perspective of I'm going to miss the upside. Where's Solana going to get to? Is it maybe going to go to 300? Maybe. Am I happy with $20 to $250, then compounding those returns? Yeah, absolutely. I'm happy with that. And as we get further into the cycle, prudent risk management is to reduce exposure, wait for the right time, have capital, and allocate when markets are losing their cool. Okay, moving on. So just to sort of highlight those, just to highlight these frameworks. So thesis for every trade on Substack, I've posted them. I'm sure heaps of people have already watched them. Thesis, entry, exit, invalidation level, journal. And the best thing about it is I have a whole bunch of folks that are then talking about it, disagreeing, agreeing, debating, that sort of thing. So I think it's absolutely fantastic. That's one of my biggest unlocks. So thesis for every trade, and then journaling. I love to journal. I start everything with Dear Diary. Dear Diary, today I want to talk about policy-induced recessions. No, I'm joking. I love journaling because it helps me. I don't have to rely on thinking back to what did March of 2020 feel like, when markets were dumping. I can go back to my journal and I've described it in detail. And this is one of those examples where the lesson in the journal was don't trade the data in policy-induced recessions. So in Q2 2020, COVID, shutdowns, everyone was at home. We had a policy-induced recession because everything shut down, and that scared markets. And the reason it scared markets was because there was no clarity, and markets and businesses need clarity in order to be able to operate. So the moment that there was clarity, through discussions, talks, social media, all of that, then markets started ripping higher. When they realized the world wasn't over, markets started ripping higher. So don't trade the data in policy-induced recession. So in there, I put bottom line, in policy-driven shocks, the edge isn't in trading the data, it's judging when policy stabilizes enough for capital allocation to resume. If you recall, there was another recent policy-induced, it's not a recession, but a policy shock. That was the tariff announcement in April or a bit earlier, but the dump in April 2024. So I knew that the moment there was clarity, based on my journaling, the moment that there's clarity, markets will rip higher, especially if they've come off the highs. And we saw, S&P dumping 10-15%, NASDAQ dumping 20%, the Bitcoin horrific dumping, Solana down 65%, that sort of thing. So what was the outcome? The moment that, so knowing that once we get clarity, things will clear up and markets will rally. And the moment that my RORO tool flipped to risk on, I posted one newsletter on April 7th, market shift alert, my risk on signals just flipped. And then because I had such high confidence that, guys, this is a big bottom and a generational buying opportunity, I then did another newsletter that week, which I typically don't do because it takes me quite a while to write these newsletters, but I didn't want anyone to actually miss this if they were in the community. So, and then I posted as well on April 8, as of today, and due to the reasons outlined in my latest newsletter, and most notably the buy signal from the RORO tool, I'm now fully deployed. That was across eToro and personal holdings. So the beauty, this is what I talk about when I talk about having an investment framework, having a strategy, having a thesis, executing on that thesis. Okay, let's answer a few questions because I can see them popping up. Okay, so lifestyle, want to live, take some out of our profits, but keep on investing as lifestyle. So enjoy profits, but without touching the retirement projects. Yeah, completely agree. Do the other Gen Xers agree? Yeah, absolutely. So that's exactly what I was modeling before. You mentioned, but without touching the retirement project. So I was like, the strategy is like, what do I need to do so that whatever I have, let's say the number's 2.5 million, like we modeled. Whatever I have, how do I maintain that? That's what I'm trying to get to. Like, and then what sort of portfolio return do I need that I can just maintain that and grow that preferably as well? Who's doing the tracking? I read it recently. Long term as how long? Now got to run because work's starting. Thanks for sharing. Have a good day. Absolutely. Thanks, Mariam. Can you let us know on eToro when to allocate, please? So Smizen, there's two times that I would there's three ways that I'd say allocate. One of them is when I'm all cash, which the portfolio is 85% cash now. So it's okay to allocate. The other time, again, not financial advice, the other time is when we've had a big red day, week, or month. So what that big red means to you, it's different for everyone. So you might say let's say you're copying me already with $10,000 and your portfolio draws down 15% to 8,500. Well, then that's your trigger. So make it systematic. That's your trigger to allocate. So anytime my portfolio goes down, portfolio holdings with Filip goes down 10, 15, 20%, whatever it is, then you allocate. Note as well that the higher the number that you put, let's say a 20% drawdown, go over my history and you'll see how many times a year I have a 20% drawdown. It might be once a year. 10% drawdown, I might get that 3 or 4 times a year. So that's kind of how you want to look at it. Once or twice a year on average. There you go, Max. Nice one. And what are you looking at to see happen before getting back in? Yep, we'll cover that. We'll cover that at the end, Alzo. What's the average yearly cost on eToro for copying you? eToro subsidizes me. So there's no yearly cost for copying me. eToro subsidizes me by keeping me on the platform and paying me a 1.5% performance fee of assets under copy to keep me on the platform. So they don't. So you don't pay anything. Of course, there's spreads and fees and stuff like that for opening and closing positions, but you don't actually pay anything. Matt, current TP and Sui, we'll get to that. In how many years will you reach your goals? Will you write all yourself or with AI? So I've reached my goals. The goal that I had set for myself, I've reached my goals, and we've got some plans in the works now for our sort of next stage of life. You write all yourself or with AI? I write on my own, but I use AI every day. And then I debate AI. I debate ChatGPT. I'll have it criticize my work, tell me where I'm going wrong. What do they think about the work that I've written? How could I improve it? I spend all day talking to ChatGPT. So just because I write the contents doesn't mean that I'm not using it as much as possible. I couldn't say greater things about ChatGPT. In fact, I have an intern that was working for me full time that now works for me like, I want to say like 2 hours a week now, because there's just not enough for him to do. everything that I had him doing, now ChatGPT does it faster and to a higher degree, and to a better degree. So moving on to what is the RORO tool. So RORO tool, simple. It's designed to take the guesswork out of portfolio allocation, provide me with directionality on a multi-month time frame. So all I want to know is, should I be long or should I close my long or be short? So it's basically telling us whether we should risk on or risk off. Why do we have the tool? Because we're trading 70 vol assets that can draw down horrifically. So I want a tool that takes the emotional decision-making out of it. The tool is best during periods of increased volatility. So like the final year of a bull run, not saying this is the final year, but in the final year of a bull run, during black swan events, it'll get us out of that. And during macro regime changes, so going from bullish to bearish macro regime. The more money that we have to invest, the more that psychologically it plays a part in it. Psychology plays a part in it. You know, $1,000 portfolio, yeah, sure, I can get 500% returns on that. But would I do that with a $10 million portfolio? Would I trade it the same? Probably not. Would I be psychologically thinking about it from the same perspective? I don't think so. There was someone in one of my posts that recently said, like, you know, you've taken profits, you know, they're holding the majority of the assets in altcoins. And to me, that simply says, yeah, but you don't have, my entire net worth is in crypto. It's in stable coins for the majority of it now, like my eToro portfolio in cash, but all of it is in crypto. So I can't be just being like balls to the wall. I'm just going to be max allocated at all times. There needs to be strategy. Otherwise, I'm riding the cycles all the way up and all the way down. So that's what the RORO tool is for, basically just to get us in and out of medium term. So think 3 to 6, perhaps 9 months, but 3 to 6 month time horizon, get us in and out of positions or let us know when the regime is changing. So that's the RORO tool. And this is an example of one of the indicators in the RORO tool. So one of them is global interest rates, GDP weighted. These are the backtest results for the global interest rates. What do we have? Between 1st of Jan 2018 to 9th of September 2025, with a starting equity of 100 grand, the ending equities is 4.1 mil, or a strategy return of 4,038%. I would never rely on one indicator and just go off that. That's why the RORO tool, as you can see, has 20 indicators. One of them is US economy, which is a subset of 7 indicators. But this is one example of the global interest rates indicator. And remember, my goal is to outperform a HODL BTC strategy. So my indicators need to be set up and tuned as such to outperform a HODL BTC strategy. Does this mean that they're going to outperform HODL BTC? No, it just means historically they have. So I look at Sharp, I look at number of trades, maximum drawdown, time in market, because I need it to align with my strategy. I spend most of my time in the market, so 50, 60, 70% of the time. I try to trade as little as I can because of the capital gains tax implications for Australians and other folks around the world. I try to reduce my drawdown. So I want to make sure that the max drawdown is, as low as possible. I want to keep a high Sharp ratio, and I want to outperform a HODL BTC strategy. But then what does that look like? This is an equity curve. What does that look like? So all it's doing is I've built out the tool, which basically says I've got all the central banks, developed economies. I can see their interest rates. Are they cutting or are they hiking? And then I do it GDP weighted to understand, like, okay, well, if it's a US that's cutting, GDP wise, they're the biggest, right? So they would have the biggest impact on this indicator. So red means, and as you can see the trades on here as well. So it went long at the start of 2019, and then it closed that position at the top, the first cycle top in BTC in March, April of 2021. did some more trades, went long again this cycle in July of 2023, closed the position and immediately went long again, and has been riding that entire wave. So this is exactly what I want to see in these tools. This is just one example, global interest rates. And that's what I use to sort of get me in and out. This is another example, RORO number 9.3, CPI inflation. So it's a nowcast data rather than historical data. So why? I don't want to know what has happened in the economy historically, last month, last quarter. That's not giving me any intel. What I want is real-time or forward-looking data. That's all I want to know. Because as good investors, we should be thinking about what's the future going to look like 6 months from now, and not be trading based on what's happening today. Oh no, this mainstream media article came out and markets are dumping on that. That's irrelevant. What does the future look like? That's where we want to focus our time on. So because CPI isn't important, as you can see by the equity curves, it outperforms a HODL BTC strategy. I use a nowcast, which is a real-time inflation assessment from the Fed. So again, I look at the max drawdown, trades, time in market, that sort of thing. And that's what it's telling me basically. Like, this is right in line with how I trade. I want a low drawdown, number of trades over 7 years, 24. It's a little bit on the high side, but okay. Time in market, 44% of the time. I like to spend 60 to 80% of the time, so it's there or thereabouts. So that's the risk on, risk off tool. And then I've got the selling the top indicators as well. So these indicators, they track indicators that have historically called the tops of crypto bull markets. If an indicator hasn't called the top or missed the top once, I don't want them because there's plenty of them. So it gets removed from the list. And it's basically a quantitative strategy to help us offload our crypto holdings based on sentiment, technical analysis, and on-chain data, because that's what these indicators are: sentiment indicators, technical analysis indicators, on-chain indicators, rather than emotion and narrative. And the other thing that they'll do is, let's say I've got a TP, I've got a take profit target for Solana at 400. Let's say these indicators start going off and Solana's only at 320. Well, that's my cue to take the position off the table at 320, because I did not size, I didn't set the TP level appropriately. So that's the other reason why we use these selling the top indicators, to give us a sense check of like, hey, all of these indicators are going off. And also, as you can see, there's 30 of them. Why do I have 30 of them? Because then it captures the people that look at global liquidity cycle, the people that watch on-chain data, like NUPL, net unrealized profit loss. It captures people that look at technicals, sentiment, traders, institutions, retail investors. All of them get captured when I've got a whole list of them. And I've also weighted them as well. Or the Jedi tier indicators have the highest weighting. Then the normie tier indicators have a slightly lower rating, and then the pleb tier sentiment indicators have a weighting, but they're the lowest weighting. So these indicators, selling the top indicators, are powerful at local tops. I've also got a buying the bottom indicators, but I haven't shared them publicly because I only launched the Substack community chat in early 2023. This is an example of a selling the top indicator. It's net unrealized profit loss. And once net unrealized profit loss gets to a certain key level, it's typically marked tops. It's marked tops every bull market from, say, 2013, 2017, 2021. And every time it's gotten close, as you see here, every time it's gotten close to that value, it's marked a local top in BTC as well. So it's a bit of a sentiment check. This is just 1 of 30, right? It's a bit of a sentiment check to let me know, like, okay, where are we at in the scheme of things? Just to give me an idea of, like, can we go higher from here? What's the probability that we go higher from there? Now that we've covered the strategy, we'll go into the portfolio, and I'll just check I'm at the beginning of setting up an SMSF. Can I contact you outside of this Prezzo for some advice regarding initial strategy? And if so, what's the best way to make contact? Yep, I'll leave my email. I can't provide advice, of course, because I'm not a financial advisor, but I'll give you my email. Feel free to do that. Do you look at the VIX? Absolutely. I look at the VIX and the MOVE index. Yeah. Yeah. So in terms of portfolio, I should add that I don't make decisions based on it, but it puts you on alert, right? So when the VIX is shooting up higher, you understand that something's going on in the economy, something's breaking, something. The VIX shot up, for example, during the yen carry trade in August of last year. So you know something's breaking, something's wrong. And similarly with MOVE in the bond market. Portfolio. So at the start of the year, I laid out sort of what my narratives and outlook were for 2025. I also laid out my base case and bull case and where I expected the portfolio returns over 2025. My base case was the portfolio would return between 35 and 50%, with a bull case of between 50 to 70% return. And then I had certain criteria that needed to be met for a base case versus a bull case. And so far, the portfolio has returned 40% year to date with 3 months left or 2 months left in the year. So we're right on target for the base case scenario. Trades that I took in Q3 2025. So we cut our SOL allocation in line with eToro's guidelines from 60% to 40%. Must admit, it wasn't ideal timing for me to cut, but I had no choice. I entered a SUI position with 17% of our portfolio. I entered eToro with 15% of the portfolio. Then I cut eToro for a negative 8% return. I then entered eToro again, based on my thesis, with 8% of our portfolio, so a smaller portion. I took profits on BTC, 50% of our BTC position, as it tagged my take profit target. I took profit on 100% of coin, again, tagged my take profit target. Took profit on 100% of our iron position because it reached its target. I then cut the eToro position for a negative 25% return, or a total portfolio drawdown of minus 2%. And that's all I was willing to give the market. And I'm doing a write-up on that this week as well, because there's a lot of good learnings in that one for myself. Then I took 100% of the Tesla position off the table for an 85% average return. Took 100% of the SOL position off the table with returns ranging from 5 to 930%. And then my CB most recently activated on Bitcoin for as it tagged 111,000. So we had a pretty busy Q3 2025, I must say. And typically, I like to hold my positions for greater than 12 months, especially in years like 2023 and 2024. Unless the market is euphoric, I want to hold it. If it's over 12 months, then I can consider cutting the position. But I'm keeping in mind the folks that are that get a 50% capital gains tax discount, including myself. So I want to hold the positions. But in the final year of a typical bull market, I become more active trading. The reason being because we can compound our returns that way. And you saw that with Solana taking profits in December and January of 2025, buying a little bit back as it started dumping, buying the majority back in April, and then reselling it again after it pumped over 100%. As such, those trades now sitting 85% in cash. The portfolio is 39% year to date, and we're annualizing right in line. I mean, we're annualizing above that 30% that I shared. The goal is 30%. We're annualizing at 49.77. So this is also really important to understand as well. Can I take more risk in the portfolio? Yes. Do I need to take more risk if the goal is outperform BTC and annualize at greater than 30%? No. I can come from a position of strength, wait for the right time to allocate when markets are shitting the bed, then allocate and ride that up, because that is the point of maximum opportunity and minimum drawdown. I could allocate right now and ride it for another 10%, but I'm also risking significant drawdown. So I'm just not willing to take that risk. So I need to see, someone asked as well, like, what are you waiting for? So I need to see a decent pullback, and we'll get to that in a second as well. And then in terms of portfolio breakdown, I'm holding 2 assets. I'm holding bonds, or 0 to 1 year bonds / treasuries, yielding between 3.6 and 4%. So that's my proxy for holding cash. So that copiers get a yield on their cash holdings, and I'm holding SUI because the RORO tool is risk on, and it hasn't reached my take profit targets. And then I've also got a cash balance. So why do I have a cash balance sitting there that isn't earning a yield? Because I need to have something there in case markets tank. So I need to have something there so that I can allocate in case we get a capitulation cascade or similar. So that's why I have that there. I wouldn't have it there the entire year. I just think at some point over the next 1 to 3 months, we're going to get a large capitulation. And at that point, I want to at least be able to immediately allocate 21% of the portfolio. And then I can unwind my IBO1.L treasury bond positions when markets open, and then continue to allocate as I see fit. That's why the portfolio breakdown looks the way that it is. Okay, outlook. Before we go with outlook, as our copy portfolio increases each year, won't we have to withdraw some to pay for capital gains as per your completed trades? Where on eToro can we get that? Yep. So I think someone shared that. Yeah, you will. So there's 2 ways to do this. You can withdraw at the end of each financial year. You can get a tax report from eToro. You might pay your taxes in March the following year, depending on how your accountant's got you set up. So you can then put that money aside and say, yep, I'm going to take it out of my investments. You can, with a salary income, you can just be putting money aside each month, but there's going to come a point in time in your portfolio where no matter how much you put aside each month for tax time, it's never going to be enough to cover your capital gains tax. That's the best problem to have. It means you're making bank in the markets. Your salary doesn't even cover how much tax you have to pay. I mean, we're coming at it from an optimist perspective, but it means that your portfolio is substantial. So yeah, you should be either taking money out or putting money aside. So yeah, definitely. eToro UI is not the greatest. Nothing I can do there, my friend. It's crazy. With BTC now getting normalized with ETFs, is it still a good indicator to measure against? Well, that is the benchmark for crypto funds. The benchmark is BTC. So, I mean, what else would we measure it against if not BTC? So as a predominantly tech / crypto portfolio, if I was being fair, what would I measure against? It's BTC. But many people don't measure against BTC because they don't underperform. In fact, one of the most copied, if not the most copied, investor on eToro measures himself against the S&P 500. Meanwhile, he's holding all tech stocks. Well, in that case, I'm going to measure myself against the bond market, 0 to 2%. Yeah, I've made a 40x return on my benchmark, which is the bond market. Like, it's sometimes. Personally, I think BTC is the way, but I'm open to suggestions. So when you pull out, do we also have to pay capital gain? Yep, exactly. So those trades are logged as if you've made those trades, and you will have to pay capital gains. So hence me saying that I don't like to trade unless absolutely necessary. I don't like to take positions off the table unless absolutely necessary. The other thing I take into account, and many of the Substack community members will know this as well, is many of the folks are actually on the highest marginal tax rate. So they're paying 47% tax in Australia. So if we're not waiting 12 months, we're giving half of it away to the ATO. So I'm trying to maximize the yield, maximize the return while taking into account that highest marginal tax rate. Can you use eToro? Please explain. SMS account in eToro, Harley, is that what you meant? Cool. Outlook. Okay, so on September 28th, I dropped a newsletter that said lower before. Oh, sorry. Hello? Hello? Do you want to say something? Nope. Okay. So a few days ago, I dropped a newsletter that said short-term lower, medium-term higher, and that was based on a few things. That was market structure. So BTC broke market structure, Ethereum broke market structure, all the majors broke market structure, ETH, Sol, Sui, XRP, Hype. So what that tells me is the highest probability. And by the way, I had sold before this. This was me just looking to allocate. What that tells me is that the highest probability trade when all of these tokens are breaking market structure, the highest probability direction is down. That said, what did we get? So far, we've gotten BTC has then, so what do I mean by market structure? Putting in higher high, higher low, higher high, and now we've broken market structure and gone to put in a lower low, then put in a lower high, and now it looks like we've put in a higher low, and now we're putting in a higher high. So it's broken market structure back up to the upside. So what does that mean? In the immediate term, it means that we're probably highest probability that we're going higher from here. Would I like to allocate 50% of the portfolio here? Yeah, absolutely. But I'm not Jesus. So what does it mean in the immediate term? We're probably going higher from here. What does that mean for the position that I have on in Sui? If BTC holds that level, it'll pull back, of course. But if it keeps trending in the right direction, for my Sui position, because BTC's market structure has been invalidated, I expect Sui to follow suit. It's lagging. BTC will run first, then majors. So what I expect is Sui will break that $4 lower high level that it had put in a few days or weeks ago. So I'll just continue holding Sui. And then I've also got a stop loss on Sui or a circuit breaker that says anything below $3 and I'm cutting the position. Now, why would I do that? What about if it goes to $1 million after it takes $3? Well, if Sui drops to $3, that tells me that it's a key level there. I don't want to lose any more money. What I've also noticed as well is if we just look back to April, you can see that Sui can very quickly get to $1.40 or $1.50 or whatever it got to back in April 2025. It's at $3. It could go to $1.50 in a matter of days or weeks. I don't want to lose 50% of the portfolio of the position because I'm holding it. Now, what I can do is cut below $3 and buy above $3. And I might get chopped up in that price range, but that's the price that we pay in order to avoid horrific drawdowns. So I might say, cut below, sell. Oh, it's come back above with strength, buy. It cuts below, sell. I could do that, and I might lose 3%, 3% in buying, selling, buying. But that's better than a 50% drawdown. Or I could just not buy it and just say, cool, I've cut that position. I'm waiting for something else. So that's how I'm playing it. So in the immediate short term, I'm talking about like moving forward from here, I expect markets to keep rallying for whatever reason. BTC, for whatever reason, has broken market structure to the upside. I expect them to keep rallying. Could this last 2 weeks and dump? Yeah, sure. What I'm also expecting is that we get some sort of capitulation based on this cycles theory that people have, some sort of drawdown based on this cycle theory. It might be in October, it might be in November, but I'm expecting some sort of capitulation. And that's where I'm looking to allocate. You might be thinking, wait, why are you looking to allocate? It's the end of the bull market. And the reason I'm looking to allocate is, and you might be asking yourself, is this time really different? And I believe it is. And the reason I'm looking to allocate is because the RORO tool, remember, it's a multi-month direction of which way we should be positioned. RORO tool says risk on. I don't have to think about what my emotions are telling me or how how much sleep I got. Okay, RORO tool, risk on, we've got a capitulation, allocate, that's it. So then why is my medium term time horizon risk on, and why is this time really different? Is this time really different? I think it is. So if we look back at the prior cycles, we can look at the 2018 crash, and we can look at the 2022 crash, and we can look at what drove those market crashes. And as you see here, I've got primary macro drivers, geopolitical events, and crypto-specific triggers. So what happened in 2018? We had quantitative tightening by the Fed. We had rising rates. We had a strong US dollar. We had hacks and tech issues and bans on ICOs and stuff like that. But these primary macro and geopolitical drivers are the things that caused the crash. Not because of a 4-year cycle, not because, you know, Bitcoin halving happened in X year and 4 years later. I don't buy that. I actually don't use time as a metric for deciding whether I should be risk on or risk off. Is there some reflexivity associated with cycle theory? Yes. And I'm banking on that. I'm banking that people are going to want to sell their tokens because, oh my gosh, the cycle is over, the 4-year cycle is over, and I can then sweep up those tokens and sell them 6 months later for 100% gain. Yeah, that's exactly what I'm banking on. And then if I look at 2022, what happened there? We had aggressive rate hikes, again, rising rates. Now you start thinking, oh, okay, well, that's why he has rate hikes or global central banks easing or cutting or hiking. That's why he has it in the RORO tool. Why? Because aggressive rate hikes again. We had inflation. You start thinking, okay, that's why he has CPI, RORO number 9.3 CPI in his RORO tool. You had Fed quantitative tightening. You had a stronger US dollar. These are all part of the RORO tool. So then you had the Russia-Ukraine war in Feb of 2022, and then post-pandemic inflation, which is why there was aggressive rate hikes. And then you had a whole bunch of stuff that marked the bottom of the bear market, like the Terra Luna collapse, FTX collapse. But if we focus on the macro and geopolitical drivers, are we seeing that here? That's the question that we should be asking. And my way of determining that is just to build tools to tell me that. I can look at them cutting rates and be like, no, they're not. But that doesn't give me any intel. So I build tools to help me understand that. So the RORO tool, as of today, says risk on mode. It's green across the board. Blue means no signal, with a few red in here. These are all weighted, by the way, in order weighted to give me the best backtest results. We've got negative US net financial liquidity. One of my technical indicators is red. Nowcast data, so the CPI is at 3%. Typically, it's red. We're still doing QT, but we've got risk on mode and 84% bullish. So I don't need to think twice about it. On a medium-term time horizon, 3 to 6 months, I want to be allocating. So I've taken profits. Now I bide my time, and then I allocate when the opportunity presents itself. But to validate that further, let's have a think about what we're seeing in this current regime. We're seeing that recession, and there's recessionistas all coming out on social media. It's non-existent. Why? Because we can look at the GDP nowcast data and the GDP results that have just come out, mind you, and you can see that there's no policy-induced recession signals anywhere. The US real GDP is exploding higher. So, okay, no recession. Do we have policy-induced shocks? You know, tariff fears. Is this going to be an issue? This is my geopolitical risk index. It's captured by RORO number 6. So, do we have do we have any geopolitical risks? So, as you can see, the indicator red means red. Yellow means caution. It is sitting, you know, above the caution and below the red. So it's not giving me any meaningful signal that from a geopolitical risk standpoint, there's anything that's, you know, a reason to worry. And even if this was, we don't use one indicator, we use 20 indicators to help us, give us confidence and confluence in the decision. And then you look at like, okay, well, does this indicator actually work? Well, here it signaled risk off during the tariff fears. So in March, in early March, it signaled risk off. Here's Israel, Iran, it signaled risk off. So it's doing its job. So then we look at USD. Remember, stronger dollar is not supportive of risk on assets. Well, the current regime is the US dollar is weakening. And what I like to use is the support levels. So you have long-term support levels for the US dollar. And then when it breaks through that support level, we typically see a rally in BTC, which is the orange chart. Blue is the US dollar, or the Dixie dollar index, or the Dixie index. So as it breaks down, BTC, which is my proxy for risk, rallies. Breaks down, rallies. What did we recently see? Break down, rally. So again, RORO number 5 says the USD continues to weaken. Nothing for me to worry about. Then we look at, I said we were in a fiscally dominant regime. We look at things like global liquidity. I've got 2 tools for global liquidity, RORO 1 and RORO 2, and China's a good part of that. But you see China is ramping up fiscal stimulus with about $1 trillion injected into the economy since December 2024. You don't have to believe me. Go check their ETFs or their China 50 or whatever in the stock market, and you'll see them absolutely on a tear. Why? Fiscal stimulus. So that's RORO 1 and 2. And I just want you to think about these things, not just me showing you the charts, but think about these things and what they mean as well. Like, okay, if I'll just go back to this one, if the recession is non-existent and if there's no geopolitical risks to worry about right now, and the US dollar is weakening, which is supportive of US risk assets, and we've got central banks printing money to juice their economies, and this is another one, the current regime, and I built a Druckenmiller death knell. Druckenmiller is my boy. He's the person that I look up to as a fund manager. He's had 30 straight years of green. He's never had a down year, which is absolutely insane. But what he often says is the US dollar, 10-year yields and crude oil are pushing higher. If they're pushing higher, it's a death knell for markets. So I built a composite tool, which I backtested. I should have put the backtest results up on here anyway, but I built a backtest tool, a backtested indicator that takes into account all 3 of these. And when all 3 of these are trending lower, it gives me a risk on signal, which you can see by green. And when these 3 are trending higher, obviously there's levels. It's not just trending higher. There's some smarts to it. But when these are trending, when it's trending higher and above a key composite threshold that I've come up with based on backtests, then it's risk off. And this is the S&P 500 here. So if we look at every time in history for the last 25 years, if I look at every time it's shown green or red, what do I see? In this regime, when it's red, when they're trending higher, it's usually asset prices or equities dumping. And when it's green, they're ripping higher. So why am I sharing this? Because this is supportive as well. This flipped green a few weeks ago as well. And if Stanley Druckenmiller is saying that this is what it is, there's a reason why it rallies, right? There's a reason why the S&P rallies, not because Druckenmiller said so, but if Druckenmiller is looking at that, then every other portfolio manager is looking at that. And if they're all looking at that and they're managing hundreds of billions of dollars and they're taking hundreds of billions of dollars out the market, then you can see why we see dumps exactly when this tool goes off and pumps exactly when this tool goes green. We saw it. This is April 2025. At the bottom, it just went green. Happy days. And then we start thinking about it from like a more long-term perspective. What are we seeing? Capital expenditure on AI is ramping up, and if you've spent as much time as I did talking and debating and getting life advice and therapy from my own AI, you'll know that this isn't just one of those bubbles. It's a real thing. I can see the productivity it's given me. I've already told you I've reduced the hours of my intern from full-time to 2 hours a week. But capital expenditure on AI is ramping up. And this is captured by the ISM manufacturing PMI indicator. Not the number, but the indicator. And the question we should be asking ourselves is, do we see capital expenditure in recessions? or in down markets? And the answer is no. You don't see this level of capital expenditure in down markets. Why? Because when we're having a recession, when we're having rate hikes, all of this, the businesses are consolidating. They're firing. They're not starting new ventures. They're consolidating their assets. They're hodling. They're tightening their purse strings rather than expending capital, because they want to stay liquid. They want to stay afloat. They want to stay in business. So when you see capital expenditure ramping up on AI, and to this degree, by the way, I mean, what did I hear the other day? I heard that the biggest project, oh, I'm going to stuff up the numbers, but the biggest project, infrastructure project in US history was something like some railroad project, and it was like $150 billion for the entire project. Some railroad, I don't know, I'm not US. But then when you look at these numbers between 2024 and 2030, you'll go from, say, 220 to 500. So you've got capital expenditure in the order of magnitude of $280 billion, larger than the biggest capital infrastructure project in history in the US. So this tells you the amount of CapEx. And then one that's near and dear to my heart, because I'm a power systems engineer by trade, is capital expenditure on energy infrastructure ramping up. So if you've been following this CapEx on energy infrastructure, you'll know that over the course of whatever it is, the last 200 years, the US has had a base load that's slowly been increasing, but a base load of whatever it is. 1 gig, 10 gig, 20 gigs, it depends on the network service provider. And between now and 2027, many of the network service providers or distribution network service providers are going to be doubling their base load. Because what does that mean? It means that more customers are coming online. But what does that mean then? Well, then you need generation to supply those customers, because right now there's a shortfall in generation for the amount of load that needs to be added on the network, because load and generation is balanced. You don't have all this generation and just this little bit of load. You need to have it balanced. So if we're doubling the base load, well, then we need to double the generation or some factor for generation. And then you need to spend money on energy infrastructure. So then when you take that into account, that's another one to add to the bank. Reducing QT, and this is captured by the RORO 9.4. So the Federal Reserve is actively reducing quantitative tightening. I don't know if they'll go into QE or quantitative easing, but if I just look at their balance sheet, I can see that the slope or gradient is decreasing. They also tell us that they're slowing down the rate of QT. But I can look at that and I can see that they're reducing QT, which historically has been supportive of risk assets. And then again, I've spoken about rate cuts before, but when the percentage of central banks that are cutting rates is increasing, so too does the price of Bitcoin or risk assets. And when the rate of central banks that are cutting rates is decreasing, so too does risk assets. So this is captured by RORO number 3, global interest rates. So if you put all of that together and disregard everything you've heard on eToro posts, X posts, social media, mainstream media narratives, all of that, disregard everything and go, does this sound like a pro-growth or growth restrictive backdrop? Does this sound like the start of a bear market? Does this sound like an environment I want to be sidelined for? If you can answer those questions, it's very clear, at least to me, that we're going to continue in the medium term. We're going to continue trending higher. Is there going to be increased volatility because the NASDAQ is at all-time highs, the S&P is at all-time highs, the Russell 2000 is at all-time highs, the FTSE 100 near all-time highs, the ASX 200 near all-time highs, BTC, crypto market cap, commodities exploding higher, gold at all-time highs? Yes. Is there going to be volatility? Absolutely. But is this something I want to be sidelined for? No, which is why my default is I'm looking for the next trade. When we get that drawdown for whatever reason, be it reflexivity, fund managers de-risking end of the year to, spruce up their portfolio so they can show their 8% returns to their clients. Whatever it is, I don't care what it is, but I'm looking to allocate. So, ladies and gentlemen, we are in a risk-on regime. So, hence the reason why we're actively looking to reallocate when the opportunity presents itself. Am I going to reallocate at any point? No. Will I reallocate heavily when the time is right? Absolutely. And that is all I had. So let's have a look at some of the questions. Far out, losing my voice. 4:30. Okay, so it's been 90 minutes. I'm sure people don't want to be stuck in this, so I'll try to get through it as quick as I can. I hope there's a way we can rewatch this meeting. I'm based in Dubai. I'm in the office right now, forced to mute frequently. Would love to watch the recording uninterrupted. Yep. Okay, thanks, Jihad. Alzo, holistically, do you think Trump is retooling or restructuring? Let me just bring this across here. Holistically, do you think Trump is retooling or restructuring the US economy to protect it from overseas competitors like they did against Japan in the 90s to be able to compete? All that debt needs to produce something. Yeah, that's a really important question, because remember at the start of his presidency, what did they say? They're going to cut costs. They implemented Doge. They're going to be fiscally sensible. Once they realize that's a no-no, that's not going to fly with the American people. What was the tune changed to? And you can see Scott Bessent was the one that started spinning the next narrative, which is we're going to grow our way out of debt. Personally, as an asset holder, beautiful. I'm licking my lips going, okay, that's fantastic. You're going to grow your way out of debt. I'll just hold assets, sit back, relax, and let the good times roll. But the one thing that's also happening as well is when you're going to grow your way out of debt, anyone that's not holding assets, they're going to be chewed up via inflation. So if they're going to grow their way out of debt, that means inflation's going higher. They're going to run the economy hot. Inflation's going higher. Anyone that's not holding assets is going to feel poorer, feel like they can't spend as much money. They don't have enough discretionary spending because inflation is eating away at their salary, at their wages. So do I think they're going to retool or restructure the US economy? Yeah, I think everything that they're doing is doing that, like putting tariffs on, washing machines and whatever else. And he wants the manufacturing back in the manufacturing of goods that are important back in the US. Doesn't care about, where our textiles and where our clothes are made, but he does care about technology. Yeah, exactly, Jonathan. The recording will be shared in Substack. Is your eToro account set up as business or personal? We can't actually set it up as a business account. I've tried so many times to set it up as a business account, but they said no. There was a period of time where they were allowing some PIs, but they don't allow it anymore. So it's set up as a personal account. Jonathan, thank you, my man. Appreciate you. Mira, thank you. Isn't Trump restructuring to make himself richer? Like that question, my take on that is like, does it matter? Like, does it matter for us? Where all I'm concerned about is I want to grow my wealth. So we just play what's given to us. Like whether he's restructuring to make himself richer, poorer, cooler, fatter, skinnier, it doesn't matter. I'm just playing the card that's dealt. Maybe, like the answer could be maybe. Does it matter? All that matters to me is I understand that what the macro environment is from my perspective and allocate based on that. But in terms of like, what I think of Elon Musk and the work that he's doing and blah, blah, it's just irrelevant to me. I think you should change your nickname to Project 100X. Yeah, I'm at 6x or 7x returns since I started eToro. I can't wait to get to 10x so I can post about it. Raphael, thanks, my man. Cheers, appreciate you. eToro question: how do eToro fees influence the investment's profits? I have the feeling that buying, selling crypto on eToro is extraordinarily expensive. There's a 1% spread, but the way that I'm doing it is I'm allocating on a high time frame basis I'm expecting 30, 40, 50, 80, 100% returns on my investment that I'm allocating to. So if I need to pay a 1% fee to get 100% return, cool, I'll do that. You know, if I don't want to pay the fee for my entire net worth, then cool, I don't have to have my entire net worth on eToro. So that's how I'm kind of how I think about it. To me, it's negligible, that 1% fee. Thanks, Jihad. Appreciate you, man. Thank you, Mindchip. Appreciate it. Smizen, thank you. Thanks, everyone. Thanks, Tanya. Aga, thank you. Thanks, Tony. Thanks, Sam. Thanks, Michael. Thanks, Adam. Opinion about Master versus Bitcoin and about Fetch AI. Good question. So, Master, what's the move index doing? If you chart the the VIX index. If you chart VIX and you chart Master, you'll notice that the Master will rally when the VIX is elevated. But if there's no volatility, then Master's not going to rally. In terms of long-term investment, I'd rather be allocated to Bitcoin rather than Master, because I don't know what they're going to do with Master. With Master behind the wheel, with Master, there's people behind the wheel. If there's people behind the wheel, there's a possibility that they're going to F it up. So if I'm going to allocate, if Bitcoin's already annualizing, let's call it 30% over the next 10 years, 5 years, whatever, then I don't need to take that additional risk. Remember, I want to take on as little risk as possible for the maximum return. So that, to me, allocating to Master, even if it does double, is taking on additional risk that I don't need to. Why? Because my entire net worth is in the space. So I don't want to be taking on any additional unit of risk that I don't have to. And Fetch AI, personally, that's a 2024 like August narrative. The latest narrative is perp dexes and privacy. So what do I think about it? I think it's not going to go to new highs. With November midterm elections next year for the US, it feels like it's cheery all the way till then, with minor correction along the way. Yeah, I probably agree with that, to be honest. With minor corrections along the way, yep, that's bang on the money. What happens after the elections, I have no idea. Yeah, the big thing to look for is inflation, right? If inflation, the Fed now is going into rate cuts. So sooner or later, we're going to see inflation. It's just a matter of how much they're willing to put up with before they start having to hike rates again. And that's our cue. So watching that inflation number and seeing their cues in the FOMC with Jerome Powell is the cue to get out of all markets. The moment they start hiking rates, it's going to be all over. Very informative and exciting. Appreciate you, Matt. Thanks. Yeah, done deal. PJ, thank you. Appreciate you, Harley. Thank you. Thanks, Sune. Thanks, Laura. eToro exchange rates and spreads are more expensive, but the peace of mind I get by knowing Phil has it under control is worth it for that portion. I've got enough to worry about. Thanks, Bonnie. I appreciate you, man. Thanks all. If there's no other questions, I guess we'll leave it there. Sorry it went a little bit over, and I hope you enjoyed it. Feel free to leave a comment, join the Substack, leave a comment on eToro, let us know, give us any feedback. Appreciate you all coming down. Thanks a lot. See ya.